Well, ladies and gentlemen, welcome. Welcome back to the Council of the Americas, to the program today that we're looking at the price of oil and the implications for the Western Hemisphere. You know, oil is a little bit like the weather, and weather's on everybody's mind today for obvious reasons, which is to say that everybody talks about it, but nobody does much about it. And so the price goes up and the price goes down based on supply and demand, and it affects all of us, and it certainly affects the Western Hemisphere. But we want to understand a little bit more why that is, how it is, what are the implications broadly in terms of macroeconomic policies, and in terms of the development of the region. And we have a terrific opportunity, I think, this morning to be able to do that. I'm Eric Farnsworth. I head the Washington office of the Council. Delighted to be your host today. You may have noticed that we have two of the promised three speakers before us. The third speaker is on a train between here and New York and should be arriving hopefully presently. But the hope is that when he gets here, we'll fit him right into the panel and have a seamless transition from that perspective. Before I actually introduce the subject and our speakers this morning, I would do a couple things, I think, to call to your attention. The first is that we have a number of materials out front that don't necessarily relate to the topic at hand, but certainly are priorities for the Council, our quarterly magazine, certainly registration materials for our annual conference coming up in April. This material is there for you. Please take it, because it means that we don't have to take it back to our office. And so we would appreciate that very much. The second thing is, with regard to our conference on April 20th at the State Department, and directly relevant to the topic at hand today, we have confirmed the U.S. Secretary of Energy, Ernie Moniz, to be one of our speakers. Now, we have a lot of other speakers as well, but he is certainly somebody who I think for an energy-related audience would be of direct relevance to the topic at hand this morning. For the past several years, with the support of the Inter-American Development Bank and some private sector entities, the Council of the Americas has run an energy action group, which is headed by Christian Gomez, who put this program together this morning. What we seek to do is to bring attention to the most compelling issues on energy in the Western Hemisphere, not just to understand them, but also then to provide input to decision makers and policymakers in terms of sound practices on efficiencies and clean energy and integration and all the things that might impact people where they live, literally. And this discussion is part of that. Over the last several years, we've had programs across the hemisphere and meetings, and you know, we're always talking about issues within the context of a high oil price environment. So for example, the deep water activities off the coast of Brazil, or Mexican energy reforms, what does that mean? Or the shale gas revolution that has been sweeping certainly the United States, but the Western Hemisphere as well. All with the idea that high energy prices necessarily and opportunistically will bring high investment. It's natural, it's normal, it's a good thing. That investment, in turn, leads to governments who say, you know, we have a lot of money coming in. We can probably do something with that. What can we do with that? Well, we can build roads and bridges. We can build healthcare systems. We can build education systems. We can do other things with the money, right? But there is that assumption, or at least there has been that assumption, that there is a flow of money based on high energy prices. And governments have begun to factor that into things like growth rates, social development, national budgets, to the point where it's not a dependency, but it's certainly something that people anticipate and expect and want to continue. What happens when that doesn't continue? What happens when you have an exogenous fall from $110 per barrel of West Texas Intermediate 6 months ago to $50 a barrel? What happens to those estimates of economic growth if you're anticipating 2 additional percentage points of GDP, for example, as Mexico has done, based on energy reform, in terms of implications for your ability to meet the raised expectations of your citizens who are now joining the middle class, who are now hoping for a better life for themselves, for their children as well? What does that mean? Are there political implications here? Our contention would be yes, but we don't know what. So that's what we're going to ask our panelists today. They're the ones who know all these answers.
Not political.
I'm trying to goad you into it, I know. But this is the type of conversation that we hope to have. But before we can actually do that, we have to understand what's going on in the sector. Is the framing that I've just done, is that the way it is? In other words, are things as, is the macroeconomy as directly related to the price of oil as perhaps I've linked it? Or are there other factors that need to be considered, and if so, what are they? But first, what we want to do is look at these issues from an industry perspective and begin the conversation there, and then we'll broaden it out in terms of the macroeconomics, and then when our third speaker gets here in terms of the financing. Our first speaker this morning is somebody who I think all of you know pretty well. If you don't, you should, because he's been around these issues for a very long time and has done a terrific job leading the policy debate on the energy side for some time. You have his bio in front of you, so I won't go deeply into it, but simply to say Leandro Alves is a friend of the council. He, until recently, was at the Inter-American Development Bank, where he headed the energy department there. But now he's in the private sector, and he's putting all that important work that he was doing on the policy side to work as a private investor, as a founder and principal of Flavez Energy. And so he is directly looking at these issues across the region, and we are anxious, Leandro, to hear from you on these topics. Our second speaker will be Adrienne, who is the Deputy Director of the Western Hemisphere Department at the IMF. And she is somebody who looks at the broader region and the broader implications from an economic and financial perspective, and I think certainly has done a lot of writing, a lot of speaking, and a lot of thinking about these issues. Truth to say, ladies and gentlemen, look, the price of oil, the fall in the price of oil is only a phenomenon that's occurred over the last 6 months. Nobody predicted this. We are all in some ways in the same boat here. I mean, if you predicted it, you'd be very wealthy and you wouldn't be sitting in this program right now, right? You'd be on a beach somewhere. That's a good thing, but the point is that we have to figure this out because there are broad implications that affect the entire region. And together, I think we can do that. Leandro, we're going to turn first to you. As I mentioned, as I set you up, the truth is I've set you up now as the investor non-pariah in the Western Hemisphere, right? So with that as a guide, however, give us a sense from your perspective now, how you're looking at the issues, the price fall, the implications for investment, what investors are looking at. Just give us a sense of how to view the sector. Okay.
So maybe given my other colleagues that will be speaking, I'm going to focus specifically on the energy sector and how it affects on a per country basis, and also how it affects the different subsectors within energy. So there's a distinction between electricity and energy. And I think one of the things that I was always promoting when my 17-year stint at the IDB was the idea that what Latin America has to offer are two things: an abundance amount of natural resources and a relatively small population. So if you combine those two logistics, it makes a very, very interesting dynamics for a region as a whole. So on the difference between electricity and energy, one can see a couple things that come to mind. One is oil on an energy side is a liquid fuel. So the predominant use for oil is transportation. And that's also starting to be shifted. If you look at what the trends are and what the major oil companies are looking at, and even the car companies are looking at, is a shift. It's a small shift right now. You have 1%, 2%, 3% of the cars being either electric, hybrid, or natural gas. But that shift will continue. And I think that's an important aspect. The second is infrastructure. If you look at the transportation infrastructure in Latin America, it's very dismal. So you see most of the commodities, because Latin America is a commodity-based economy, is all exported through oil, through trucks typically. There's few trains. So you have a logistical issue there that the reducing oil prices are going to be tremendously important for the local economy. The other aspect that I want to raise is, everybody always looks, and particularly on the climate change issue, and I know it's been put in the back burner ever since the financial crisis in 2007, 2008. But if you look at the climate change, what is the proper approach to sustainable growth? And Latin America is a prime example. If you look at Latin America, most electricity side of Latin America is clean. It's basically predominantly hydro. And you look at the per ton of CO2 emissions of Latin America compared to any other region in the world, it's always the cleanest. I always say this, I always make a comment is, what is the greenest country in Latin America? Everybody always says, you know this, you've been to my speeches. So Paraguay is the cleanest country. Everybody says Costa Rica because they're such a good marketing entity. But Paraguay is the cleanest. It's 100% of electricity is hydro. And the rest of the countries are moving towards that, albeit there are some environmental issues and implications that may put a damper on that. The last kind of point that I want to point out is on the export side. You have 6 hydrocarbon export countries in Latin America, which base a lot of their social programs, infrastructure, and so forth on exports of hydrocarbon, either oil or gas. On the gas side, how does gas couple with oil, and what's the implication? There has been a decoupling between natural gas and oil in the past 10 years. So you have oil as a market-based, where you can just put it on a freighter and go anywhere. So you have an international oil price. And the gas price, typically in the past, has been an oligopoly system where you only start producing gas or created an LNG plant when you had a 40-year contract on the other side. Some of those 40-year contracts on the LNG have now gone merchant. So you're starting to see a little bit more merchant gas, but very few. And that's very clear by the difference in gas prices between Asia, Europe, the US, and even Latin America. The prices change substantially. And maybe I'll just go in just a very quick anecdote, real life on the issue of gas as it relates to oil. Now with the company that I'm running, we are looking at a gas field in West Texas. It was originally a hedge fund bought, it was 77 oil wells, 16,000 acres. Originally, a hedge fund bought this last August, so it's not that long ago. They paid $20 million for it. They put $7 million, and just last week they wanted to sell it for $1.2 million. So they would have lost $26 million on this deal. And we looked at it and we turned it down. And everybody said, why can't you turn down a deal that was, just 6 months ago was a $27 million venture, and now it's a $1 million venture, and we still didn't want it. And the reason is, two reasons. The first is that 30%, in this case, in this particular project, and it's very consistent with most gas production, particularly shale production, is you have byproducts on the gas side. So when you extract gas, shale gas, you have anywhere from 10 to 30% or more of liquid fuels. So sometimes it's oil, sometimes propane, and other mixed gases. Once the bottom falls out of those 30%, the economics of shale may not be sustainable, particularly with the gas price in the US being what it is today. So what happened, the play that happened in August, where the hedge fund came in, they said, okay, we're going to buy this 16,000 acre gas field, and we're going to do horizontal drilling, and then we're going to extract the shale, and we're all going to be very well off. As soon as that 30% price dropped, it didn't make sense for them to go horizontal because 30% of their revenue stream is now half price. So that project collapsed. And we see a lot of that in the US. What's the implications of this for Latin America? So there's a couple things that I think is interesting. One is we're looking at a paradigm shift. And I've been talking about this for years, and it's finally maybe coming to fruition. Is that liquid fuels used to be the cheapest source of energy in general, electricity and energy in the world. And then the prices went up in 2005 all the way up to now, and it became very expensive. So alternatives were coming in, energy efficiency and so forth. And now with the price coming back down, you're saying, well, we're back to square one. But we're not. Things have changed in the last 10 years that have made this shift or reduction in oil price a much more prolonged period of time. And the shift has been energy efficiency, alternative energy, use of mass transportation for the urban areas where consume a significant amount of energy. So all those things are shifting from liquid fuels into electricity. And the electricity, yes, they can be run on fossil fuels, and typically Central America and the Caribbean do have that implication, but those countries are also having a shift. So I think on the regional specific, Central America and the Caribbean have gotten a break now because a lot of their electricity and energy transportation have reduced in price. So they're much better off. The other countries, Venezuela, Ecuador, Bolivia, Peru, Colombia, Canada, the US, all those are impacted because those are our highly productive countries. And where do we go from here? So with this paradigm shift, you cannot just base on high oil prices that you can get away with being inefficient. And that's what we're seeing with the Latin American national oil companies. There's a huge inefficiency there, and we saw it when we financed Petroecuador. We financed a pipeline in Ecuador when I was at the IDB. Ecuador in general, Petroecuador has 90% of the reserves in Ecuador and 5% to the private sector, but oil extraction is almost 50-50. So 5% of the private companies that are in Ecuador extract 50% of the crude oil in Ecuador itself. And that's an efficiency issue. And we see that not only with Ecuador, we see it in Venezuela, we see it in Brazil, we see it obviously in Mexico with the reforms. And with the prices now creeping low, my example that happened in Texas is now happening throughout Latin America, where some of the projects that were viable before are no longer viable because the prices aren't there. And because of the corporate governance of those national oil companies and the inefficiency to extract the crude makes those projects now less viable or sometimes unviable. So that has a whole set of impacts. I'll kind of leave with two remarks. One is that the break-even prices for the oil companies in Latin America are higher than other countries. So when oil prices come down, they're not necessarily going to affect so much the Middle East oil, but they will affect the Latin oil. And the second point is that governance on these kind of national behemoth companies that have done so well in the last 5-6 years, the party's over. And they need to really change the way they focus and the policy issues, how to get the corporate governance of those companies in a sustainable area that they can produce at $50 a barrel. And last but not least, the Stone Age didn't end because we ran out of stones. So.
Well, Leandro, thank you, first of all, for framing the conversation so well. You put a lot of really interesting and important things into the conversation. Before, Adrienne, we go to you, let me follow up with a couple things, because, look, you very appropriately introduced not just the producer side, but also the consumer side, and not just from one country to the next, but within sectors in economies, for example, Brazil. And I think that's an important point that a lot of people have missed. I would like to develop that theme a lot further. We don't necessarily have time this morning to do so, so let me turn to the other topic that I wanted to follow up on, and it's the point you ended with, which is to say, look, every country in the world is in a globally competitive environment. And the issues of, market risk certainly are there. But talk to us a little bit about how investors might see other risk factors in the Western Hemisphere. You talked to corporate governance, you've mentioned infrastructure, et cetera. What is it that a country, and you can use a specific example or not, doesn't matter, but what could countries be doing better that would draw that investment even in a low energy price environment?
Sure. So as an investor looking at energy projects in general, what do we want? We want predictability, we want sustainability, and we want to make sure the rules don't change. What we've seen, and unfortunately or fortunately, what my job now is focused on investment grade countries. So if the country is not investment grade, we can't attract the capital from the US, the Europe, and the Asia to go into those countries. So the first country is the first kind of order of business is how do regular investors, and our investor base is pension funds. So the pension funds has a very high threshold. So if you're not an investment grade country, they just won't go into regardless what the returns are. The second is within those countries, there's two big issues. One is change of law or regulations, and the second is the volatility of the underlying commodity. And because of those areas, we are focused exclusively on renewables and on wind in particular. And we just didn't want to take volatility of price risk. So once you have a lot of other aspects that come into the capital structure as an investor, it's very difficult for you to predict what oil will be. Everybody's losing their shirts that went into. And then on top of that, when you have these other, which are cost of capital, as soon as you put in, non-investment grade country, you have to, the return have to be higher. As soon as you put volatility of either gas or other commodities, the returns have to be higher. And then those returns just don't live up to expectations and nobody goes into those countries. Why are what we call the non-investment grade countries in Latin America finding it so difficult to attract significant amount of investments? And it's as simple as that. So I think going back to what can countries do and what's the policy? First is don't change the rules. Whatever has been although it's better to have bad rules than change rules. And the second is, have micro changes. The second is all these have to be profitable on all sides. A lot of countries that we went to, which are commodity-based countries, the main thing is how can I get this? I have a wonderful raw material. It could be, bauxite, it could be electricity, it could be gas. How do I market this underlying commodity, which is in my country? I said, great, you have to mitigate country risk. How do you mitigate your own country risk? And that's a huge, huge implication. But investors will not go. So there's a number of ways you can structure around it, setting offshore accounts for where the commodities get paid and so forth. So there are ways to do it. But it is one more, and the countries don't normally do that because it cuts into their sovereignty. Once you start trying to mitigate their national risk, they say, no, we don't want to do this because it's going to, all the other future deals will be done this way, of course. But that's the way you get started. And I think from an investor perspective, that's how do you mitigate country risk and lack of governance.
Mm-hmm. Terrific. No, I'd like to follow up a lot more. Let me bring Adrienne into the conversation. This is a great way to get us going this morning. Thank you.
You're welcome.
So governments have been relying on some of this income, factoring it into projections. We've talked a lot about the commodities exporters of South America in particular, a little bit about Mexico as well, some on the upside in terms of Central America. We really haven't talked about the Caribbean, which also has a unique activity in the context of reliance on a certain energy activity. So how do these types of factors figure in terms of the macro side?
Well, before I talk about the Caribbean, let me talk about the whole region.
No, I wasn't. Yeah, exactly. No, I just wanted to make sure that we cover the Caribbean at some point, but not that you start with it.
No, I'm really happy that you said that, because I think typically we tend to think of the oil producers, and obviously we have to talk about the oil producers, but half the world is oil importers. And there's an upside to the oil price decline as well. So before I get to the hit to governments in oil-producing countries, let me talk about the overall picture for growth, if I may. For me, the question that we're asking is, what's the impact of the oil price decline on the region? And to put it in perspective, the view was that the oil price decline would have a positive impact on the world as a whole. In the IMF, we estimate, Olivier Blanchard estimates that the oil price decline will boost growth by a range between 0.3 and 0.7% in 2015. So we're better off, the world is better off by that amount. However, Latin America and the Caribbean, I say LAC, I don't know if everyone says LAC, is not getting a net boost from the oil price decline. We're estimating that the region comes out broadly neutral. And that's because of a different balance of oil producers and oil importers. Should I interrupt and say hi?
Well, no, you're doing great. I'll do a proper introduction after you're finished.
Okay. So, in fact, even despite the oil shock, the oil shock, which is good for the rest of the world, we've revised down our growth projections for Latin America, and we've revised them down more than for the rest of the world. The IMF's growth projection for the region in 2015 is down to 1.25%, which is the same as last year. In other words, no boost from the oil shock. And it's almost 1% lower than we previously expected. So despite the oil shock, Latin America is not expected to do very, very well this year. And that's for a combination of reasons, a continuation of the commodity price decline more broadly, the impact of investment, which you started to talk about, and I'd like to come back to. The impact is more negative than in the rest of the world because of the large oil producers. We're estimating negative growth of around 7% in Venezuela this year, which is quite severe. We've cut our estimated growth for Ecuador in half. Colombia we've reduced by about 1%, and Bolivia and Trinidad are also affected, even though they're natural gas producers. We don't see the oil shock as having much impact on Brazil and Argentina, and Mexico is still projected to grow above 3%. Before I come to the importers, let me talk about what underlies our projections. I'm waiting to hear from Vladimir. Let me change gear a bit. One of the reasons our projections are so depressed is because we already see quite a large investment decline. And for macroeconomists, this is actually a puzzle, because we tend to think of investment in the energy sector as being driven by long-run considerations. Now, what you're describing is quite quick reactions to short-term price changes, and that's what we're seeing. We're seeing quite a pronounced accelerator model in investment. Investment kind of dried up. I'm thinking not only of the oil producers, but also energy producers more generally. There was, in some sense, nearly a sudden stop of investment. And we're seeing that not in the regional oil companies, but also in the big global companies. Their investment in 2014 was lower than in 2013. And we're seeing statements from them of projected lower investment again in 2015. So that's, for us, that's mainly driving the negative impact on growth.
Can I ask, is that, you're talking about the Western Hemisphere, or are you seeing that occur globally as well?
We're seeing it globally as well, but we looked both at the big regional oil companies, the nationals, Pemex, and obviously PDVSA, which should obviously skews the averages. So we see it at the regional level, but we also see it in the big globals, in Exxon and Chevron and so on. From this survey that we've done of their investment estimates for 2014 and expectations for 2015. Now, coming back to the positive side, how does the oil price decline boost growth? It boosts growth by improving private sector disposable income. And the question is, by how much? In the region, not all of the price decline will be passed through to the private sector, but we do expect a large share to be passed through to the private sector. One of the issues is, will the private sector gain, or will governments tax the oil price decline away? And we looked at pricing mechanisms in the region, and we find that probably if you take the combination of pricing mechanisms that are in force at the moment and government's policy statements about whether they're going to change them or not, we do expect about 60% of countries to have full pass-through within 2015. So quite a big positive boost to oil importing countries that are seeing, that are receiving oil at lower prices. Now let me turn to the Caribbean, if I may.
Sure.
So who gains the most? It's the small countries with the big oil bills that have, in percent of GDP, quite a large decline in their oil bill, and that's Central America and the Caribbean. Let me talk in particular about Petrocaribe countries, which is most of the countries in the Caribbean and Central America. These are small importers, so they gain from the cut. On the other hand, they're quite exposed to Venezuela, because they get most of their oil from Venezuela. And the issue is, if Venezuela's finances are jeopardized by the reduction in oil prices, will they have to cut back their support for Petrocaribe countries? So one question is that a big deal? So these small countries have remained pretty exposed to Venezuela. Financing was about 2.5% of GDP for these countries on average in 2014. So it really hasn't come down much, despite the fact that we've been warning countries, don't be careful, diversify your sources of financing. Don't remain too dependent on a country which may have to cut off its supplies. And some countries are even more vulnerable. Nicaragua and Haiti get more than 4% of GDP in financing from Venezuela. Guyana does too, but is saving. It isn't exposed because it's been saving the financing that it gets. And other vulnerable countries are Jamaica, Belize, Antigua. Now, all these countries gain a lot from the decline in oil prices. On the other hand, Petrocaribe financing goes down and the terms harden as oil prices go down. So the question a lot of us are interested in is, on net, what happens to Petrocaribe countries? Are they better off because the prices have gone down, or are they worse off because the financing is being withdrawn and the interest rate is higher, and so on? So there is a range of prices where they were worse off, but the prices now have fallen so much that all these countries are on net terms better off than last year. So in other words, even though Petrocaribe terms have tightened, these small countries are better off. They need less financing than they did last year for their oil bills. And so they've all gained in net terms from the price decline. The projected improvement is around 3.75% of GDP in their trade balance, and the decline in financing is less than 1% of GDP, so a significant gain. Then the question becomes, well, what happens if Venezuela were really to run into trouble and to stop supplying oil altogether? So the reduction in supply and the disappearance in financing would be more drastic. Even then, only Haiti and Nicaragua would not gain in net terms. So this difficult policy discussion that we were having over the last couple of years, that countries needed to be very wary of their vulnerabilities to Petrocaribe. That's the drop in oil prices has been so pronounced that that's almost gone away. Not completely, and obviously we should worry about Nicaragua and Haiti, but in terms of country resources, everyone now has been cushioned by the oil price decline. Mm-hmm. Now let me finish with one point which is not as happy as that. The problem for these small countries is that the gains will go to the private sector in terms of lower oil prices, to the extent that there's pass-through. The losses go to the public sector. And so one of the issues that we've been working on is how exposed are public sectors, as opposed to whole countries, to the decline in Petrocaribe financing. And we estimate that by now, almost all the countries have started to have their budgets rely on Petrocaribe money. So they would have to adjust if it disappeared. We think even this year, as the financing declines, but Petrocaribe continues, the adjustment that governments they'll either need to adjust or find alternative financing of around 0.75% of GDP, which is quite a lot for these small countries. And if Petrocaribe were to disappear, the governments would have additional financing needs or need to adjust of around 1.5% of GDP. Mm-hmm. So maybe that's more detail than you needed about the Caribbean, but I think this has been one angle that we've all been worried about, these small countries. So the countries are better off, but the governments may have a problem.
No, I think it's terrific. And one of the things that we don't focus on is things until they become a crisis. And it's interesting to see how, a lot of people have been talking about the Caribbean in almost a pre-crisis mode, but what you're saying is the impact hadn't all been dramatically negative. In fact, there's an upside here. I think it's a really important leavening that you've just given in terms of the conversation. Still not to say that the region doesn't need a lot of watching. and care and careful attention, et cetera. But it's a very interesting perspective. Now, the reason why I ask that particularly is Council of the Americas has done a lot of work in terms of Caribbean basin energy. And the Vice President hosted a ministerial a couple weeks ago, which we co-hosted. I mean, it's a really important topic from an economic perspective, but also in terms of a policy perspective, but also, foreign policy. Look, the United States has a lot at stake in the Caribbean basin, whether we want to acknowledge that or not. But this is a historical connection to the United States, and I think it's appropriate and important that we continue to look at these issues in the context of the overall hemisphere. So thank you for helping us do that. Very good. Well, our third speaker has arrived from New York. He gets my award for Superman of the Year because his train was canceled, I think, 19 times before you actually got one that worked.
Two trains canceled, and the third one was perfectly on time.
Well, third time is the charm, I guess is what they say. And as I'm introducing you, maybe move up the microphone a little bit closer. There you go. Would be terrific. So we are honored and very pleased to have as our third speaker today, Vladimir Werning from JP Morgan, who I said, as I mentioned, has just come down from New York, especially for this. He is a real expert on some of the financing and other issues surrounding energy in the Western Hemisphere, speaks on these issues a lot. And with great expertise and credibility. I believe you also have a presentation that you brought, is that right?
Yes, actually I have some material which I left outside, so if you want to pick it up, it's brief, but it has all the key numbers looking at oil from a balance of payment, fiscal, growth, inflation perspective. So, there's a lot of angles to talk about the oil price shock to Latin America. And I think, my intention of bringing this material was to give you clarity on all those dimensions. Mm-hmm. But you can look at it afterwards. So
make sure you pick up a copy is my point. You have his bio in front of you, or you should. So I'm not going to take the time because I'd rather hear from you than talk about you. So thank you for coming. Thank you for joining us. And what we've heard now, you heard the most of Adrienne's commentary. Leandro talked to us about how energy investors are looking at the Western Hemisphere in the context of the oil price decline and some of the things that make investment attractive or not in the current circumstances and what governments can do to try to improve those circumstances.
Yeah. Okay. Well, thank you very much for the invite and sorry for the delay. I think the way at JP Morgan we're looking at the oil price shock, first of all, I'd say at the global level, declines of 50% in oil prices are rare. Similar declines have historically produced sharp declines in inflation, credit market stress, and large monetary easing. The question is, what does this shock bring us? The relationship between oil and growth there are patterns, but it's not one way. We've had, depends on the supply or demand nature of the decline in prices. So, prices regularly fall sharply during recession, but price collapses have also generated accelerations in growth, 1987, 1999. So the question is, what has driven this oil price shock? And I think in our firm, we think about 2/3 of it is attributable to supply side. And that's why on a net basis, we think it is a positive for global growth. In our view, it adds about 6 decimal points to global growth. Now, the issue is that, for emerging markets, and Latin America in particular, things are not so straightforward. The other third of the price decline, we think, is attributable to last year's underperformance, particularly in emerging markets. So as we look forward, I think there are several contrasts between our global view and what we're thinking about in Latin America. So in that respect, I think we are tracking around $51 year to date on oil, and our forecast for this year is $49. However, I'd say we were expecting a bit of a rebound in the second half. So the actual prices are tracking a bit above what we expected at this point. To some extent, some of our specialists have suggested that the worst of this is behind. Now, obviously, the skid marks of these oil price declines on the macroeconomy, persist. The economies are more slow moving, and as they digest this shock, we're going to see how those issues manifest themselves, and particularly in contrast to the global economy. In Latin America, we have cut our growth forecasts, and we have nudged up marginally our inflation forecast. The latter, in particular, affected by Brazil, I'd say, not necessarily the common theme for the rest of the countries, but that's a big difference from what we're saying at the global level, where we're seeing inflation come down and we're seeing expectations of growth going up. On the whole, I would say that we are looking for in Latin America growth. Last year we had around 0.6% growth according to our estimates, given GDP weights in the region on average, and the latest we're looking for is 0.5%. So practically no acceleration in growth this year. I'd say in terms of inflation, if we just focus on the inflation targeting countries, leave aside capital control or dollarized economies like Argentina, Venezuela, and Ecuador, and we just look at the Brazil, Chile, Colombia, Mexico, Peru, Uruguay, we're looking at inflation around 4.4% versus 5.2% last year, so some moderation. But actually, if you look at our forecast for growth and inflation, just before the oil price shock for 2015, we were expecting 4.3% inflation for 2015, so a decimal point higher after the oil price shock. We were expecting 2.3% growth, which is below potential for Latin America, just before the oil price shock for this year, and now we're expecting 0.5%. So the overall shock is a negative one, and I'd say that the main channel that we've emphasized in the U.S. and in other places, which is the transfer of the windfall to consumers, that's what we are generally not seeing in Latin America. I mean, there are some variations, but we have, I'd say, first of all, net exposure is much lower than gross exposure. I mean, here we have oil-dependent economies of Venezuela. We have large net exporters, Ecuador and Colombia, and then most of the other countries are within 1% net importer to 2 decimal points of net exporter. That's Mexico, Brazil, Peru, Argentina, and there's a few smaller countries, Chile and Uruguay, who are actually importers in a significant magnitude. Those countries like Chile are seeing the pass-through. But the large state oil companies basically are focused on preserving the fiscal transfers and income that their companies provide in Mexico for the budget, in Brazil, in Argentina. So even if there's a bit of flexibility in some countries modestly down, I mean, what we've seen in Brazil and Mexico, for instance, is prices going up. They may not have gone up as high as they were scheduled to go up before the oil price shock, but they've gone in the opposite direction. So consumers are not really getting a benefit in the way we're seeing it. And the countries, most of these countries are trying to consolidate the fiscal accounts. I think when we think about Mexico, it's very prudent. They have an oil price hedge, so presumably their fiscal resources shouldn't be affected this year. And yet they understand, and they're taking a precautionary approach by which, if this is a permanent shock, which is always the difficulty for a policymaker to determine if it's going to be permanent or temporary, and the reaction is different. Well, they're taking it as a permanent shock, and therefore they know that they'll have to make a fiscal adjustment next year. And because of that, they want to spread out the burden of that adjustment. So they're starting early. They're starting in the second half of this year. So that's a prudent approach. Brazil, the fiscal restrictions to pass through the price has to do much more with the fact that for idiosyncratic reasons, they need to rebalance their macroeconomy. Part of the story of Latin America in 2015 is the oil price shock, and more broadly speaking, the commodity price shock, because even though the oil collapse has been the most spectacular aspect of it, even net oil importers, in our view, are going to have a tough time in terms of getting their economies moving, because other commodity prices that they export, metals, agriculture, have gone down. And so even at those countries that get the benefit because they're net importers, the few countries, They still have to digest national income losses from the terms of trade on the other side of the balance of payments. So it's going to be tough. But I think Brazil has its own macroeconomic rebalancing. It's pretty much completely independent of what's going on with oil, and it's one of the big themes for our region. They need to reinstate their fiscal anchor. Otherwise, the burden of tightening on the monetary policy front, which is already quite aggressively priced into markets, will have to continue. And their economic performance is going to be quite low. We're expecting a recession in Brazil. And the downside risks remain. So I think that the good news is many economies have flexible exchange rates. I mentioned fiscal priorities is one reason consumers will not get fully the benefit. The other one is currency weaknesses. So domestic prices do not, even if they were to be passed through, would not be one for one with the dollar price decline. The currencies have depreciated. So those are key issues. I think we leave aside Venezuela. Venezuela has massive oil wealth and massive macroeconomic imbalances, and I think one can echo what was said earlier, that they're at the forefront of the need to adjust. I think in general, markets are pricing in a 68% probability of default in 1 year's time and 95% in 5 years' time. I think they have had a policy paralysis issue, even that was worrisome even before the oil price shock, and the need to not just devalue the currency, and they're taking some steps now, but also unify the system so as to avoid arbitrage and leakages that leave reported imports very high and the balance of payment vulnerable is a big challenge, and we don't know if they're up to moving as fast as needed. But meanwhile, they are rejigging their balance sheet using assets, sales, et cetera, to keep making good on the debt payments. But definitely that's one issue. But it's very different from the rest of the region, and I'd prefer to leave that aside maybe for the questions. So with weaker exchange rates, with state oil companies' pricing and fiscal targets in mind, less pass-through to the consumer, I'd say that on the growth side, the oil and gas sector, even in countries where they're not large net oil exporters, say Mexico. Mexico imports oil, exports oil, consumes a lot of oil internally. So the actual net balance is not large. But gross investment in the oil sector is significant. And so just like what we're bound to see is that sector is going to be under reductions. And Pemex is already going to scale back. This is a good opportunity for foreign companies that have financial backing to get in. The bidding process that Mexico has, presumably the authorities want to move as fast as possible given the schedule they had in mind, despite the oil price shock. And definitely Pemex will have to make room for others to take those opportunities more than before the oil price shock, just given their financial capacity to be a dominant player in those bids. But I think we have a margin squeeze for the oil companies. We have limited new finds in Colombia, for instance, and we have the Lava Jato investigation in Brazil. All these things will undermine investment in the oil and gas sector and have spillover effects to contractors and other sectors that are related. As I mentioned, the parallel factor that undermines GDP, in our view, also is the fact that while oil prices are the large price decline, we do have declines in metals and agro. So those are issues. And we don't have as much policy easing as we had in 2008, 2009. We expect Brazil to keep hiking rates. We expect Mexico to start normalizing interest rates this year and continue gradually next year. And we only see Peru potentially easing monetary policy. The rest of the countries probably on hold. And again, on the fiscal side, it's more of a story of tightening rather than loosening. So it's very different capacity to cushion the shock vis-a-vis 2008, 2009. And the key final point I would highlight is that this past year has been a year of underperformance with very high inflation in the region and very, very low growth and currency weaknesses. Despite the currency weaknesses, despite the domestic demand adjustments, current account deficits are very wide still in the region. except for Chile. Chile is the one country that actually we revised our growth forecast for this year modestly. It's still a very mild acceleration. But the perception is that they've moved forward enough in their currency adjustment and domestic demand adjustment that the balance of risk are probably tilted modestly to the upside now. The rest of the region, the risk is tilted to the downside. And I think that it's important to notice that in this context, ECB's quantitative easing has been a blessing because it gives the countries more time. The financial flows remain there. Our own estimates are that G3 balance sheets, with what the ECB is doing, is compensating for what the Fed is doing, and therefore overall financial flows remain. Remains a lot of liquidity in the global financial markets, and that's a good thing for the region, because otherwise, given the terms of trade shock, given the wide current account deficits, we would probably be forecasting deeper growth adjustments this year, even weaker currencies. So I think to end on a positive note, that gives policymakers more time. But I think the market will discriminate between those policymakers, like in Mexico, which basically take a bit more conservative view and try to adjust to a potentially permanent state of affairs with lower commodity prices, versus those that do not use the time provided by the ample global liquidity to gradually make those adjustments. It's a big political process to do them. And if you have time, it's good. But if that time is not used wisely, then eventually what wide current account deficits will leave is a risk of a hard landing in the pipeline for the future, for next year, or whenever financial markets, if they do, have a retracement in liquidity.
Vladimir, I think you have been the first person ever to successfully introduce into a Council of the Americas discussion the phrase skid marks. So thank you. That was very well done. We appreciate it very, very much. And you know, over the last 10 years, give or take, you know, we heard a lot of triumphalism, if you want to use that word. Maybe that's not your word, it's mine, coming from the region in terms of, you know, our economies are doing well. You in the developed world, particularly the United States and Europe, are not doing so well. We've got the key to growth. We've figured this out. Now it seems as if you're suggesting that going forward, not just 2015, but certainly based on the continued reliance on the commodities sector broadly, not just energy, that we may have some choppy waters ahead of us, certainly in some of the larger economies in the Western Hemisphere. Am I interpreting that correctly? And how would you kind of play that out for the future, understanding that, you know, predictions are subject to revision?
Yeah. No, I think, look, the region has, we know that the reason they've been able to have counter-cyclical fiscal and monetary policy independence during the Great Recession, why they've been able to manage policy better, is because they've built buffers. They've improved the composition of debt. They've improved fiscal balances. They have currencies that today are flexible in most cases, and the pass-through is limited, so they can engineer relative price adjustments more rapidly. So these are all positive things, and I think some of those things are there. The buffers for engineering countercyclical policy are much less, however. That's a big difference in this business cycle than in the last downturn we had. And one of the structural difficulties of the region is generating a reduction in current account deficits and a rotation of growth drivers to external demand without a recession. Even despite the currency weaknesses, few countries are able to generate a rapid enough rotation to support their economies on the basis of external net exports that in the process of that rotation, most of them have to experience a recession. Otherwise, current accounts don't go down. And again, I think long end yields today are low. There's time to make these adjustments. But I think one of the political consequences is many of these countries are focused on sort of the tail end of the commodity boom, which was income distribution agendas, you know, how to improve the welfare state and spend to you know, more wisely and bigger government. And that was consistent with the income gains that they were having. And the prudence that they had in terms of managing their accounts in the initial phase of the upswing. But those degrees of freedom have really narrowed down, and I think the market will be very selective, increasingly so, in terms of considering countries that shift focus a bit more on supply side, on potential growth. So there's these two policy agendas. Income distribution is very popular all around the world, not just in Latin America. But when the belt has tightened as much as it has, I think the market will be attentive to those countries that also, in parallel, reinforce and reinvigorate the growth agenda. And I think it's not easy because expectations of local populations have been placed very high, and politicians have to deliver. But the fiscal leeway they had is less so now, and I think the sooner that's acknowledged, the better the path of transition will be. So it will be choppy, not just economically, but also politically.
Mm-hmm. Well, that is a great way to segue into a conversation with those of you, to the extent that you have questions or brief comments that you would like to make with regard to the panelists. Let's take a round of three. I think we have a circulating microphone, do we not? Yes? All right, I saw first, and then way in the back second, and then three, and then we'll come back here. So one, and then two, and then three. If you could identify yourself by name and organization, that would be great.
My name is Judith O'Neill. I'm with Cellular Messenger Alert System, CMAS Holdings. I have a question for Leandro. And the first question is that shale play in Texas that your company declined to invest in on a 99.5% off sale, if my math is correct, was that predominantly gas or oil? And if it was gas, I have a question about your prospects for exports of gas from the United States. Touches on something that Vladimir said.
Thank you. Let's take three in the round. We'll go to the back. There we go.
Yes, good morning. Thank you for the wonderful briefings that you've given. I have a question for Vladimir. As I was observing the drop in the oil prices, it seems as if the prices dropped almost concurrently with the cutting down or diminishing of quantitative easing. How much of the price drop is also the result of that quantitative easing drop in the strengthening of the U.S. dollar?
And could you identify yourself, please, for the
Sorry,
panel?
Sergio de la Peña, independent consultant.
Thank you. And then right here, please.
Thank you. Thank you very much for those presentations. My name is Christopher Webster. I'm a former Foreign Service officer with the State Department and spent much of my career working on Central America and the Caribbean. My question, I think, is best addressed to Mr. Alves. I wonder, in light of the drop in oil prices and the issues with Petrocaribe that the lady next to him identified, do you foresee possibly more investment by the Central American and Caribbean countries in alternative forms of energy, such as hydropower and geothermal and other natural energy sources?
Terrific questions, all three. Leandro, let's start with you. I think you can dispatch with the first one pretty quick, but take your time to the extent you need to. And then if you could also discuss the alternative scenario for the region.
Sure.
Then we'll go to Vladimir.
So on the gas deal particularly, there are three issues that we saw on the gas deal. As I mentioned, it was 16,000 acres. It was 70% gas, 30% what we call liquid fuels. There were, out of the 77, there were 77 horizontal wells, no vertical wells. The reason we rejected that particular transaction was for three reasons. One is on the final pipeline, they didn't separate the liquid fuels from the gas. Typically, if you want to be efficient, you actually separate it on the wellhead, and that mitigates a lot of things, particularly environmental issues. So we have 16,000 acres of gas, 77 wells with pipeline, and some of those pipelines were leaking. These are 30-year-old wells. And so for us to come in and we'd have to do two things. We'd have to re-energize the pumps. So we'd have to actually energize all 77 wells in order to separate the liquid fuels from the gas side on a per well basis. And second, we'd have to do all the environmental cleanup related to leakages that the gas passes through and evaporates or not so much, and then the liquid fuels drop down on the ground. So we think it was just from an environmental point of view horrendously expensive. And last but not least, there was issues also with the regulation. The Texas Railroad Authority, which is the one that authorizes these wells, only 12 of them were registered and paying taxes on out of the 77. So there are some issues there on royalty issues that they have to pay for non-producing wells because these were production leases. So for those three reasons, we rejected the 99% decline. No, yeah, the quality of gas, the underlying project itself, and we just thought it was just too much trouble for what it was. We do think the gas prices will eventually creep up. We're already starting to see that, precisely because the 30% margin oil has come down. Those other commodities have to come up. So the gas prices we're going to see creep up. Just coincidentally, all of our projects we're going 13-year hedge on the energy side, and then we go merchant. So we think 13 years down the road, gas prices will go higher than they are today, electricity prices. In relation to the Caribbean and Central America, so it's a wonderful break for the Caribbean to have lower fuel prices because of the oil prices. The issue is that even with $50 a barrel oil, you're still at 13 cents to 32 cents per kilowatt hour on diesel plants. So they're still significantly more expensive than other forms of alternative. And I'll give you an example what has been happening. I think one of the policy issues, when I was at the Inter-American Development Bank 2 years ago, we commissioned a study to look at all projects that had over 10 years still left in their purchase power agreement from the underlying their diesel plants. They had 10 years or more of linked oil for fixed fuel. And these were typically at 20 cents plus per kilowatt hour. Those projects actually, if you build either a solar or wind project in the same vicinity and sell it at the 26 cents, within 24 to 36 months you amortize the initial cost. A company in the DR, Heine, has done this. They put two 30 megawatt projects in the DR and they're selling it at the price that they have the diesel plant, which is the contracted price with the government. And so the way we're looking at it is the Caribbean and Central America can actually wean itself off of the oil as electricity input just by installing these kind of new technologies and renewable technologies, which undercut the price and the returns are so high. In Mexico, we're looking at projects in Mexico where we're looking at 20% return on the wind side. And that's anywhere from a 6 to 15% discount off CFE rates for industrial clients. So we think that the technology is already there and it can undercut a significant portion of any heavy fuel-based economy. The problem is, as I mentioned, is the scale of those projects are small, the country risk of those projects, and the off-taker risk.
Very good, but that speaks to a role for an international bank or a foreign government or some sort of program that would encourage those types of activities. Yep. Yeah, very good, thank you. Vladimir, to you on the question about the QE and how that's impacting the region.
It's a very interesting question because in many aspects of the global economy, QE pops up as uncharted waters, and all our economists on our team have had to think about things that have historically happened in certain patterns with a backdrop of a very different sort of financial environment here. And I would say what I would highlight is, although the Fed has tapered the QE, what interest rates have done is actually the opposite of what we would have expected, which is they've kept going down. The supply-demand imbalance in fixed income remains one that has led to the current state of pricing. So if QE would have had more of a significant impact on the commodity story, we would have probably expected it to happen in a context where interest rates were rising, and they didn't. So we don't associate the QE with what has happened in oil. I think our commodity analysts, for the most part, see the non-OPEC and the OPEC refusal to adjust supply as an important catalyst here. Obviously, the shortfalls in demand earlier in 2014 set the stage, but the trigger point was more related to the supply of oil, and obviously to the extent that the dollar reflects the unbalanced global growth story, which is one where the U.S. really stands out and other regions are weaker. It definitely speaks to some shortfalls of demand that underpins the oil price softness. But I think the way our commodity analysts are looking at it is really in terms of the real economy, supply demand, and with a big emphasis on the supply side more recently.
We're going to have to end the program right at 11 o'clock, but I think we can sneak in another round. So I promised 1 and 2, and then there's a third back here. So 1, 2, 3.
Hello, good morning. My name is Andres Barona. I am with AM Global Consulting. And my question is particularly about the future viability of the Mexican oil market. You guys discussed that in order to have a viable market, you needed to have basically sustainability, stability, and most importantly, the rules don't have to change. In the case of the Mexican oil market, well, the reforms are being implemented, so the rules are changing. The prices are obviously declining, so there's shocks there. And now with the notion of the drug cartels, they're tapping into the Pemex pipeline. So is there a future in that market, and what future challenges and opportunities do you see? Thank you.
Very good, thank you. And right here.
Very good morning. Thank you for your presentations. Francisco Gonzalez, I'm a professor just at Johns Hopkins SAIS across the street. I teach Latin American politics and a class on energy issues in the Western Hemisphere. Our IMF colleague, when she was looking at the forecasts, told us that there was a degree, a spectrum between the most badly hit, Venezuela, Ecuador, usual suspects, also hit Bolivia, Trinidad, Colombia, not really hit, at least given the forecasts, which can always be revised, Brazil, Argentina, Mexico. I think it's very simplistic to simply say, well, therefore we can say the worse hit, the higher your political risk, and those which are hit the least, political risk remains stable. What's your perspective on political risk given this different way in which the shock has affected producers? Eric, I'd be interested also in your perspective.
No, I'm very glad you asked that question, because that is exactly was on my mind as well. So thank you for bringing it to the conversation. And then right back here, please.
Good morning, Anton Edmonds. The question is to all three panelists. In as much as you didn't focus much on the Caribbean as it relates to JP Morgan, I'd invite your comments. And I want to key in on something that you said, Leandro, which is the issue of contracts and the rule of law, and how does one adjust. If we look at the Caribbean specifically, and we look at the fact that many would argue that utilities have contracts with governments which are bad contracts, the question really is one of how do we look at the issue of, yes, the prices have come down, yes, you can get into renewables, but the issue of contracts and the sanctity of contracts, how do we address that so that countries, or can we address that so that countries maintain a good profile in terms of country risk as well as investor risk for alternatives and other fuels to get into the space?
I have 2 words for you: buy out. Just kidding. All right, let's go, Adrienne, to you first. To the extent you want to get into the political risk question on Brazil, Argentina, and Mexico. And then we also have the Mexican energy sector, and then we've got the question in terms of sanctity of contracts in the Caribbean. As I said, we're starting to run up a little bit against our time window, so let's keep going.
Okay. I'd answer the question in a different way. Is political risk related to the exposure to the oil price decline? And I would say no, it's much more complicated than that. It's obviously idiosyncratic. And rather than taking Brazil, Mexico, Argentina, let's look at Venezuela versus Ecuador, for example. So in Venezuela, the political risk is very high. In Ecuador, which is very exposed as well to the decline in oil prices, they're handling it in a much more managed way. The government immediately chose to adjust the budget by about 3/4 of the cut in their expected net oil earnings. And so it's really a question of people's confidence in the government and their control over an orderly response to the oil price decline. On the Mexican, no, I think the Mexican question is for you, but on the future of the Mexican energy sector, I mean, even though the oil prices come down, the energy reforms are supposed to be transformative. And I know they're talking about delaying some of the proposed auctions and projects, but what they're really discussing is sweetening the pot for the private sector compared with what they were planning to do, and I see that as very positive.
Yeah, I think I would echo that. It's obviously a disappointment for a reform process that took so much political capital to put in place, and the changes in the rule of law there were actually in favor of private sector initiatives, so they were welcomed and not seen as something that distorted. On the contrary, sought to resolve the productivity problems and the output problems of the oil sector that under the current regime had become obviously unsustainable. So I think that, there is a degree of disappointment, but I think companies that we talk to have been very encouraged by the Mexican process, and this is about securing reserves for the long term. These are opportunities that to some extent the current oil price will affect the pricing, but I think the eagerness to look at those opportunities remains there. Obviously, the deeper water fields will be more difficult, but the government will start with the shallow. So I think what they want to get into the execution phase and show that it was not just a process of approval, but one of execution. And I think they're very executive-minded in the government and moving in the right direction. So I think overall we're pretty constructive on Mexico. I think that the other issue on the political risk, I would echo, there's a lot of idiosyncrasy here. There's a coincidence of the oil price shock, but the political issues that are generating divisions between the executive and Congress or between the opposition and the government, were there even before the oil price shock. They've just manifest themselves more intensely lately, but it's pretty much coincidence. And I think all those issues will remain in place even if the oil price rebounds.
Well, and I think that's a critical point. Leandro, I'd like your final thoughts on that as well. The question is, energy is a long-term play. Now, immediate investment decisions are certainly impacted by, immediate conditions, but at the end of the day, we're talking, you were talking about 40-year offtake contracts in terms of power sector, et cetera. This is not something that's a quarter-by-quarter thing. To the extent that governments change or political circumstances change, I wonder how that factors into the eyes of the investor. Are we looking at these as long-term issues? Are we looking at these in terms of, what happens above ground is just as important or more important than what happens below ground? And I apologize in terms of the time, but
Sure.
A final thought on that.
So just maybe 2 comments, and I'll address the Caribbean question on the contract sanctity. First is, although energy is a long-term play, the problem is that every single investment has to go to a board or a credit committee. So those credit committees and boards are getting hammered by media analysts, all telling them that the bottoms fell out. And the wise investor buys a funeral and sells a wedding. But typically what ends up happening is that doesn't happen quite often, because the committees are kind of, they don't want, if things go well, it will go well 10 years down the road. If things go bad next year, all the ones that bought the investment today and they tanked are all probably out of a job. So although they are long-term investments, nobody was willing to go in when the tide is really shaky. So that's one thing. The second, on the Caribbean issue, sanctity of contracts. I think if you give up the notion of sanctity of contracts, you're done. It takes so many years, if not decades, to recover. I think we're in a very pristine opportunity right now, because the oil prices have come down. So you have Caribbean and Central America with a little bit of luxury, although they're heavily in debt and the oil prices are still there. I think it's probably from a policy point of view, a wonderful opportunity for them to engage with those private sector entities now that they're getting a break because the input prices is lower, and see what kind of incentives they can give those same entities that have long-term 10-year PPAs at oil-based off-takers for electricity, and see what kind of tax incentives or other incentives they can come in and put solar and wind, where you have continuous production of energy, so you're not looking at intermittent energy because you already have and shutting off the oil valves, but still paying the same original contract price that you had there. So it's a very, very wonderful opportunity, and I would hope that Central America and the Caribbean would take the next year or so those incentives to really transform their economies. So if the oil comes back up from 50 to 80, they're not hit with a huge setback.
Well, you know, they say that the mark of a success in terms of show business or in terms of programming is to leave them wanting more. I want a lot more from the three speakers here because you have just really covered an immense amount of material and done so very, very well with expertise and credibility. Unfortunately, we are at time, but I hope that we can lure back all three of you at some point to the Council for continued conversations in terms of energy, in terms of the economic structure, in terms of everything else going on. What a fascinating conversation. Ladies and gentlemen, would you please join me in thanking our panelists for their terrific commentary this morning.